The grocery industry is facing financial challenges and bankruptcies in 2024. The aftermath of the COVID-19 pandemic has left many companies struggling with out-of-stock products, labor shortages, and increased operational costs. These issues are further worsened by heightened competition within the industry and inflationary pressures that keep the cost of groceries high for consumers. No sector has been spared from the turmoil, from long-standing giants to upstart health food markets. Here are 15 grocery store chains collapsing in 2024. Sprouts Farmers Market. Once a darling of the health food movement, Sprouts Farmers Market has recently struggled to maintain its footing. Known for its focus on fresh and organic produce, Sprouts Farmers Market has been coping with significant challenges ever since 2020. The company's sales volumes have been consistently down for several quarters, while foot traffic at stores isn't the same as it used to be before the pandemic. Higher transportation costs and difficulties in sourcing new suppliers have resulted in an almost 8% revenue loss last year. Sprouts has also been forced to close several unprofitable locations and reduce staff to restore its financial health. In the first quarter, the chain reported a 7% decline in same-store sales, and its stock has plummeted 40% year-over-year. Fresh Thyme Market. Focused on fresh and natural foods, Fresh Thyme Market has fallen on hard times during the pandemic and never really recovered. In some Midwest markets, all stores have been closed in the past 3 years. Meanwhile, customers say the remaining open locations do not look the same as they once did. According to Consumer Reports, product quality has been deteriorating at some Fresh Thyme markets, especially for produce, one of the main offerings of the chain. Product shortages are also making the shopping experience less enjoyable, and higher prices are making the company lose popularity as other grocers continue to capture a higher share of the fresh foods market. Earth Fare. Consolidated grocers are also squeezing health-focused Earth Fare in the current economy. The company filed for bankruptcy in 2020 and has since been working to get back on its feet. However, industry analysts doubt the company can stay in business for another year. With only 20 locations across 8 states, the grocer lacks the financial strength and market share to compete and is likely to be victimized by the ongoing recession. Kroger. Despite being one of the largest grocery chains in the United States, Kroger has been dealing with increased competition from both traditional and online retailers, and its customer base has been shrinking nationwide. However, the company is not giving up. It is trying to get a multi-billion-dollar merger with Albertsons approved, a move that could potentially help it overcome these challenges. Regulators, however, are concerned it will increase American shoppers' prices. Consequently, they're trying to shut down the proposal, even after both companies closed hundreds of stores to avoid antitrust lawsuits. Kroger has also been facing a series of labor disputes, leading to strikes and disrupted operations in recent months. As a result, the grocer's stock is performing poorly on the US stock market, and executives have just slashed Kroger's earnings outlook for the rest of the year, highlighting the financial strain on the company. Save-A-Lot. The discount grocery chain. Save-A-Lot is still finalizing its restructuring plan to sell all of its corporate stores so it can become a 100% licensed wholesaler and erase a debt load of nearly $40 million. Even before the onset of the health crisis, the company was already reporting difficulties in balancing its finances. Supply chain issues and increased competition from other discount retailers further strained the grocer's resources. Over 300 locations have been shut down in the past 3 years, and the ones that were reopened are currently under the management of independent owners, marking a significant shift in its business model to reduce overhead costs. Smart & Final is a discount grocery chain facing major challenges due to increased competition and rising operational costs. The company has reported dozens of store closings over the past year. It has even been accused of union busting for shutting down locations where workers signaled their intent to organize. The locations in question weren't reporting the worst financial numbers compared to other stores that have also gone dark. However, according to sources familiar with the matter, the chain couldn't afford to have unionized workers due to associated costs that would arise, so it decided to terminate contracts and leases early, simply to cut costs. Central Grocers is a cooperative wholesaler that supplies independent grocers in the Midwest. Since 2019, the company has been dealing with rising financial pressures that resulted in the closure of one of its subsidiaries, Strack & Van Til, and several other locations. The retailer also laid off over 200 workers at the time, with another 150 let go in 2022. Just recently, Central Grocers was accused of taking deliberate action to prevent workers from unionizing, which clearly shows how unstable the situation has become for the wholesaler. As foot traffic continues to decline at its stores, the company doesn't seem to have a way out of bankruptcy. Whole Foods Market. Amazon-owned Whole Foods Market has not been immune to the economic pressures affecting the grocery industry. The organic grocer reported decreased sales and rising operational costs in 2024. The chain has also been impacted by higher competition from other natural food retailers, offering their customers more affordable alternatives. This shift in consumer preferences towards more affordable options is a significant challenge that the industry as a whole is grappling with. Dozens of store closures and layoffs have occurred in the past year, with executives citing underperformance and changing consumer habits as primary reasons. Fairway Market, a New York-based grocery chain, has been working to restructure its operations since 2020, but without success. Fairway Market has not done enough to differentiate itself from other chains in an environment crowded with specialty grocers. It also failed to expand its business and draw more customers. Falling sales, declining foot traffic, and high operational costs have all contributed to the company's woes. Recent store closings and terminations are only the latest signs of trouble for the retailer. Lucky's Market. Another organic grocer is about to bite the dust. Previously owned by Kroger, Lucky's Market is being crushed by bigger chains in 2024. In an industry with wafer-thin margins, smaller chains are far more vulnerable to economic fluctuations. After Kroger ended its partnership with the company in 2021, Lucky's found itself with debts higher than earnings. Strategic mistakes and bad investments have also contributed to the grocer's demise. Today, fewer than 36 stores are still in operation across the country. Albertsons, another major player in the grocery industry, has been struggling with declining sales and lower foot traffic for years. Since early 2023, the company has been closing stores and laying off workers to streamline operations and cut costs. The pandemic worsened existing issues, which continue to impact the chain's balance sheet to this day. Despite efforts to boost online sales, Albertsons continues to lag behind its competitors, and the potential merger fiasco with Kroger could put the grocer at serious risk of going under completely. Giant Eagle. Regional grocer Giant Eagle is reporting mass store shutdowns as it tries to streamline its operations. Competing with names like Walmart, Target, and Costco for an increasingly smaller market share is proving harder than the company might have thought. Sales figures have been disappointing quarter after quarter, and not even the latest closings and cost-cutting initiatives are a guarantee that Giant Eagle's business model could be sustained over the long run, according to industry experts. The fresh market. According to analysts with Macro Axis, the fresh market's bankruptcy probability is at 80% right now. They noted that there is a very high risk of going through financial hardship in the upcoming years. Known for its upscale grocery products, the company has reported falling sales for several consecutive quarters. In recent years, poor management and supplier problems have quickened the chain's slump. Financial experts say the company does not look like an attractive investment right now, especially as other specialty grocers such as Trader Joe's continue to grow in popularity and expand their customer bases. Southeastern Grocers. The parent company of chains like Winn-Dixie, Bi-Lo, Harvey's, and Fresco Wymas, Southeastern Grocers, is having difficulty climbing out of bankruptcy. The company first filed for Chapter 11 in 2018 to restructure its debt, but in 2021, things took a turn for the worse when hundreds of stores were shut down due to poor financial performance. Since then, conditions haven't remarkably improved for Southeastern Grocers, putting the fate of multiple chains on the line. Hagen. Pacific Northwest-based grocer Hagen has been in financial trouble for almost a decade now. The company has struggled to adapt to consumers' changing behaviors and has been losing popularity in an already tight market. In 2015, when it filed for bankruptcy for the first time, Hagen had accrued a $30 million debt load that forced it to sell several locations to its rivals, including a dozen stores that Albertsons purchased. Since then, conditions have not dramatically improved for the retailer, which continued to shut down several underperforming stores and lay off employees to stabilize its finances. More recently, the grocer closed 5 locations in the state of Washington, citing the impact of inflation on consumers as one of the reasons behind the decision. The grocery sector has become increasingly crowded, with traditional supermarkets facing stiff competition from discount retailers, online grocers, and specialty stores. Consumers are becoming more health conscious and demanding a wider variety of organic, locally sourced, and sustainable products, forcing grocers to adapt their offerings. The rise of online grocery shopping and delivery services has also disrupted the traditional brick-and-mortar model, forcing retailers to invest heavily in technology and logistics. The grocery industry is going through big changes. Chains that fail to adapt to changing consumer preferences, embrace technology, and address their financial challenges are at risk of collapse. The fate of these 15 grocery chains is a warning for the industry. As shoppers, we can expect more mergers, stores closing, and new companies appearing in the next few years. The future of grocery shopping might be very different, focusing more on making things easier, customizing options, and being eco-friendly. In the wake of these rough times, the grocery chains that effectively adapt and withstand the challenges can emerge as leading forces in a reinvigorated industry. On the contrary, those who do not adjust to the changing situation face the risk of fading into obscurity within the rich history of the grocery sector.